In this video, we're going to talk about mutual funds. We're going to explain how they work, and I'll discuss some of the different benefits as to why people actually hold mutual funds. They represent a very viable option for investing, and there's a number of different reasons for that, which we're going to discuss over the course of this video. First, though, let's explain really what they are and how they work. A mutual fund simply is a type of institutional investor, similar to a pension fund and an insurance company. And so what they do, what all institutional investors do, is they pull money together from different sources. And so how that might look is you could have a number of different individual investors, which are going to be denoted by my super fancy stick figures. This is why I went into business and not art. And so what these individual investors do is they go ahead and they put money into a pool. And so essentially they kind of buy into the mutual fund, thus giving the people that run the mutual fund access to a lot of financial capital. And so this financial capital gets used by the mutual fund to acquire different assets. And so you might be asking, well, really, what type of assets does a mutual fund purchase? That's a really good question. They purchase everything from common stock to even bonds to money market instruments, and a variety of other assets as well. And so what this does is this represents basically a portfolio. And so I, as one of these little investors over here, right, remember my fancy stick figures, instead of buying one thing, right, purchasing a common stock or buying one bond or one money market instrument, I get to hold a bunch of them, because I put money in the pot, and then the mutual fund will purchase all of these different assets that I am now exposed to, which is great because now I hold a variety of positions instead of just maybe a few, and I only pay one particular price. And so this is probably the most significant benefit for going with a mutual fund, is you get access to instant diversification. Instead of trying to purchase and acquire each of the smaller assets myself, right, smaller securities, I can instantly get access to a variety of them. And diversification is a building block and is so important in finance, especially in personal finance and investing, because the idea is by holding a variety of different assets, I am somewhat protected from the volatility of one of those securities performing poorly. So if one does bad, it's not going to impact me that much because I have 50 others that are doing fairly well. So the downside of holding one thing is that when it does poorly, everything that you hold does poorly. When it does well, you're doing great and everyone's happy. But when the time comes for that asset to depreciate in value, to lessen in value rather, then you're going to be hit pretty hard. But if you're diversified, if you spread out your holdings for a number of different assets, you don't have that problem. And so usually mutual funds will actually show what we call their top 10 holdings. And these are the most significant positions that are held in the mutual fund. And so let me just throw out some companies and as examples here. Let's say this mutual fund may hold Apple, maybe it holds ExxonMobil, maybe AT&T, Bank of America, and we'll stop there. And so it'll go on for a list of 10, and then it'll show a percentage next to those. And so maybe it's 4.3% for Apple, 3.9% for ExxonMobil, 3.8% for AT&T, and then 3.5% for Bank of America. I made all those up. There's really no significance or anything just beyond the fact that I just made those numbers up right now. So what that means is out of the entire portfolio, first off, 4.3% of it is held in Apple stock. 3.9% of it is held in ExxonMobil stock. 3.8% of it is held in AT&T, and then 3.5% is held in Bank of America. The reason this is important is because generally it's not recommended to hold more than 5% of your portfolio in one particular stock. Anything more than that, and you're going to be more vulnerable to kind of the ebb and flow of that one stock. In this case, you're not really worried about that. If one performs poorly, you have a variety of others that are still going to be there to kind of balance out the kind of the volatility, if you will, of one stock that's not performing well. And so that's certainly one of the benefits. Now, these are the top 10 holdings, right? But the actual portfolio will hold a variety of others. So you'll be exposed to a lot of different companies in a variety of sectors if that's what your goal is. So that helps you diversify instantly, reduces your risk of being driven down by the performance of one stock. Now, you technically could do this yourself. You could go out and try and purchase each individual stock yourself. It's going to be very time consuming. Also, you're going to have a difficulty trying to get the numbers to match because you're going to see that each stock is different in value. So like Apple stock, for example, is as of right now like $425 a share. And so that might be really difficult because now, okay, you can only buy full shares. So if I buy one, that's almost $500. But maybe I need to buy like 1.5. And so it's going to make it very difficult to make the numbers work and so that you have a specific percentage. Also, each trade you execute, you pay an actual fee for that, right? It's called generally a transaction fee. And generally those fees will range anywhere from, let's say, $7.99 to about $9.99 or so in US dollars. That's about the average. And so if you're executing, 20 trades, which is very, very reasonable, it's probably an understatement to get a good portfolio, and you're spending $10 for each trade, you're spending $200 just to buy everything in your portfolio. And then if you sell, then that's additional monies that you're paying out. And so it can be very time consuming and very expensive to do, which is why mutual funds are so attractive, because I simply execute one trade. Typically, I don't pay a transaction fee. However, I do pay a kind of a maintenance fee, if you will, for actually holding the mutual fund, which we'll get to that in a second here. Now, the other benefit of holding a mutual fund is what you get in terms of professional management. And this is where the fees come in, because you have to actually pay for this person. They do earn a salary, and a rather good one. Most individuals don't have the expertise necessary to buy securities. They don't have the formal training, whether it's education. They certainly don't have the experience. And so by going with a mutual fund, you benefit from having someone in your corner that does. The professional management idea is that you have a fund manager whose sole responsibility is to ensure the optimal performance of that mutual fund. And so they will go ahead and buy and sell shares in line with the kind of goals and objectives of the mutual fund, which are laid out for you in advance so you know what the purpose of the fund is. And they'll buy and sell those to make sure that they're trying to, once again, achieve optimal performance. And so the good thing about this fund manager is typically they have some type of education. Usually it's an MBA in finance. That's pretty common. And usually they have several years of experience. And each of those things are beneficial because it just makes that you're going to get more accurate decision making. You're going to have someone who understands the markets, who understands fundamental analysis and technical analysis and those types of things. And so you can certainly benefit from their expertise. Now, the trade-off, of course, is that you pay expense fees related to holding the mutual fund, which can be 1% to 2% roughly on average. And so that's money that obviously you're not getting, but that's kind of the trade-off there. As opposed to doing it yourself, taking advantage of the fund manager, you do have to obviously pay for their services though. The next thing is that you have a high degree of liquidity. You can buy and sell mutual funds very easily, right? You call your broker up, you say, hey, I want to sell this. They'll probably try and talk you out of it. Or you go through an online brokerage firm like an E-Trade, Scottrade, Fidelity, and then you just execute the trade online, and then you sell your position, you exit that position almost immediately. So you can execute a trade pretty easily. You can get your money back pretty easily. Now, there are certain stipulations and exceptions, of course, and one of those is that most mutual funds you have to hold for at least 30 days. And the reason is a mutual fund is considered to be more of a long-term investment. It isn't meant to be bought and sold in the same day, certainly within the same week. And so they want to discourage people from buying and selling mutual funds almost like stocks, right? And so by doing so, they minimize that. Usually you have a penalty that's incurred if you sell within a 30-day period, once again to discourage people from engaging in that particular activity. Now, besides liquidity, one of the other benefits that you get from holding a mutual fund is you have a great deal of variety. There are limitless alternatives for mutual funds. You will not find or have a particular goal in mind or market you want to focus on, sector that you're interested in, type of stock that you want that doesn't have a mutual fund in some way, shape, or form devoted to it. You just won't. There are so many of them out there. You can find mutual funds for just large cap growth stocks, large cap value, large cap blend, mid, small, technology sector, a variety of different things. And so whatever your individual goals and objectives are, whatever your interest is, whatever you want to focus on, you can find a mutual fund in that area. You just have to be able to look for it. And that is certainly another benefit there. And so these are some of the benefits of holding mutual funds, in large part why they are so popular and why many investors use mutual funds is because you get instant diversification, you get access to professional management, you have a relatively high degree of liquidity, and you have a great variety at your disposal to choose from. But remember, how they function is simply pooling money together, right? We're getting all of these different funds from each of the individual investors, and we're using those funds to go ahead and acquire the assets that are going to be in our mutual fund, of course. Now, one last thing that I'll mention before we end our time here is that the price that you pay for a mutual fund is not the share price, right? The share price is what we use for common stock. What you pay for a mutual fund is commonly shown as a net asset value, commonly abbreviated as NAV. This is the equivalent of the share price for a stock. And the reason it's net asset value is because it's dependent upon the value of the holdings, right? So the amount of money that is kicked in from each of the investors affects this value. Now, this value is only updated at the close of the business day, because people execute trades and transactions on on common stock and bonds and different things throughout the course of the day. So it doesn't make sense to update this value, right, just every second. It'd be very, very inefficient. It'd be almost impossible for that matter. So what happens is after the close of the business day, all the transactions are added up, all the different holdings are figured out, and then the net asset value updates, which is why you cannot purchase a mutual fund in the middle of the day. If you execute an order, that order will be saved, and then it will be executed at the end of the day once the net asset value is actually updated. Likewise, if you try and sell your order in the middle of the day, it's not going to go through. It's only going to go through at the end of the day once the net asset value has been updated, once we take into consideration the fluctuations and the movements of the stock and the different holdings and things of that nature. So just want to clarify that there's a difference between the two. It's relatively minor, but there still is a difference nonetheless. So that's kind of how mutual funds work. Hopefully that helps. If you have any questions, suggestions, please do let me know.